Hi, my name is Matt Christensen. I'm the managing partner here at Hansen St. My practice specializes in bankruptcy and banking and other finance-related topics. Today, we're just going to discuss some highlights and high-level kind of overview of the most recent stimulus package that was passed by Congress on Monday, December 21st. It still remains, as of this recording, with President Trump to sign, discuss some of what he's indicated about the bill as we go through. The first thing to keep in mind is that this is not a standalone stimulus bill. There was a spending bill that Congress was working on and passing that is a fairly typical budget bill for Congress that they tacked some stimulus provisions onto. So there's a lot of reporting going on related to different aspects of the stimulus bill that really aren't part of the stimulus bill. That's part of the spending bill. There's not a lot wholly unusual about those parts of the spending bill. The stimulus package itself is approximately $900 billion in additional spending by Congress. How that 900 breaks down, there's about $166 billion set aside for stimulus checks, similar to the checks that many people received back in April of this year. Those checks are $600 per adult, plus an additional $600 per child. One of the things that President Trump would like to see is for those $600 checks to become $2,000 checks per adult. I believe the $600 per child would stay the same. So there's $166 billion set aside for that. There's $325 billion set aside for small businesses. Part of that is an extension of the Paycheck Protection Program loans, the PPP loans. There's also some grants to certain businesses, the biggest category being what were called shuttered venues, so like movie theaters, live theaters, that sort of thing. There's $120 billion set aside for unemployment assistance, which is $300 per week unemployment assistance that was in place previously. There's money set aside for education, for healthcare provisions, including COVID testing, $45 billion for transportation, $83 billion for rental assistance, and that sorts of thing. So there's a good breakdown in the funds that are available. Related specifically to the PPP loans, there's a new round of funding. Part of that $325 billion is set aside for those loans. In some cases, a business that got a loan previously can get a second loan if they meet certain criteria. One of those limitations is that you've got to be able to show for at least one quarter during 2020 a reduction of 25% from your 2019 same quarter. So if you're looking at third quarter 2020 and third quarter 2019, there has to be at least a 25% reduction in the gross income. They've also expanded the categories of borrowers. So sole proprietors, self-employed, some nonprofits would qualify now that may not have qualified earlier, so they can get new loans. The loan terms are generally similar. You can use the funds not just for payroll and rent expense, but also for purchase of PPE equipment, for purchase of things to modify your facilities to make them COVID compliant. If you have essential software that the business needs, it can be used to pay for that. If there's essential suppliers that the business uses, you can pay those suppliers with those. So the category of expenses has broadened, but you still have to use at least 60% of that loan for payroll. There are some of the PPP loan funds set aside for specific businesses. So businesses in low-income communities have a portion set aside. Businesses, live venue businesses have a portion set aside for them. The forgiveness application is simplified for smaller loans. If you're less than $150,000 in loan, it's a simple application. Previously, on the forgiveness side, if a company had received both a PPP loan and an economic injury loan, the forgiveness application was reduced by the amount of the economic injury loan. That reduction has been taken out, so you don't have to account for the economic injury loan. The biggest issue that Congress has fixed is the tax deductibility of the expenses paid with a PPP loan. After the CARES Act was passed in March, the IRS issued guidance that said for tax purposes, if you pay an otherwise deductible expense with funds that are forgiven, so in other words a PPP loan, then you can't deduct that expense on your tax returns. So you can't deduct it as a business expense. A lot of industry groups sort of fought that view, and Congress has now fixed it in the new bill by stating that no deduction will be denied, no tax attribute will be reduced, no basis increase will be denied by reason of the exclusion from gross income of the PPP loan. So in other words, if you pay those expenses with PPP funds, you can include them as a business deduction on the tax returns. The problem where this would arise is if you had a small business that basically broke even at the end of the year without including the PPP funds, so their other income was sufficient to get them to break even at the end of the year, but they used all those expenses that they got the PPP funds for, then at the end of the year on the tax return they would have had to show a large profit, where they didn't really have a large profit. It just showed it on paper, and now all of a sudden they have a tax bill they have to pay because of those those excluded expenses. So it fixes that problem, allows businesses to claim those expenses. A couple of tax credits that the new bill introduces or continues: child tax credit and the earned income credit. For purposes of calculating those on your 2020 return, the new bill allows you to use your 2019 income level to calculate those two credits rather than your 2020 income level. That sort of recognizes that there were likely reductions in a lot of people's income who otherwise qualify for those credits, and so that allows you to kind of go back to the year when you were making money rather than the year when you weren't, to calculate how much of those credits you can use. Additionally, the CARES Act had originally approved a tax credit or I guess a deduction from taxable income for student loan repayments that an employer made on behalf of the employee. So the CARES Act in March authorized up to $5,250 in student loan payments being paid by the employer. That payment would not be counted as taxable income for the employee, nor would it be counted as taxable income for the employer. Those payments had to be made by the end of December 2020. The new act extends that time period through December of 2025, so there's an additional 4 years. What I haven't been able to find an answer to, and it's unclear whether it's in the act or not, is whether that original $5,250 is a total that the employer can pay. So in other words, they now have 4 additional years to pay that much, or if it's a $5,250 per year benefit. So arguably over the 5-year period, there could be more than $25,000 paid on student loans that would not be counted as taxable income for either the employee or the employer. So that's an answer that we still need to learn. But that's some of the highlights of the new stimulus bill. It's been passed by Congress altogether. The president has not yet signed it, but as I mentioned, he's requested increased income stimulus checks to regular individuals. Whether he will veto the bill till that happens or whether he'll sign the current bill and just have an amendment from Congress added on later is still to be seen. So as always, if you have questions or if there's other legal issues we can help you with, feel free to contact the firm. Our website is www.angstman.com, and the phone number is 208-384-8588.